Okay, so you want to own a homestay. Buy a cute house near the beach, the mountains, the old town, or the lake. Put nice photos online. Let travelers sleep there for 2 nights at a time. Charge more per night than a normal landlord could ever charge for monthly rent. That is the dream. The problem is that a homestay is not really a house. It is a tiny hotel, a local zoning bet, a cleaning operation, a review machine, and a leveraged real estate asset disguised as passive income. From the outside, the business looks almost unfair. A long-term tenant might pay you $2,000 a month. A tourist might pay $200 a night. 10 busy nights can look like an entire month of rent. A holiday weekend can look like magic. The calendar fills, the platform sends payouts, and the owner starts to think the house has become a money printer. The first mistake is believing the nightly rate is the business. A homestay sells three things at once. It sells a place to sleep, it sells trust to a stranger before that stranger arrives, and most importantly, it sells a fixed number of perishable nights. If Tuesday night passes empty, you cannot put it back on the shelf and sell it next week. Hotels understand this because they have lived with empty rooms for more than a century. New homestay owners often learn it only after the mortgage has already started. This is why the economics are so strange. The guest thinks they are renting a cozy private home. The owner thinks they are monetizing unused space or turning a second home into an investment. The city may think the owner is removing housing from the local rental market. The platform thinks the home is inventory, the lender thinks it is collateral, the cleaner thinks it is a recurring route, the neighbor thinks it is a rotating door. All of them are looking at the same property, but each one sees a different business. Before the first guest books permission becomes the first gate. Money alone does not make a homestay legal. In some places, the owner needs a business license, a short-term rental permit, a tax registration, safety inspections, fire extinguishers, smoke alarms, occupancy limits, parking compliance, and proof that the building allows transient guests. A condo board can say no. A landlord can say no. A homeowners association can say no. A city council can change the rules after the furniture has already been bought. New York City is the extreme example of how fast the dream can narrow. Its short-term rental registration system requires booking platforms to verify whether a listing is legally exempt or validly registered before processing a short-term rental transaction. The city's enforcement office explains that to obtain registration, an applicant must demonstrate that they are hosting in the unit they live in and that the rental is legal. For many investors who imagined buying apartments and renting them out nightly, that changes the business before pricing even begins. Japan takes a different approach. Its private lodging rules allow Minpaku-style hosting, but the standard private lodging category is capped at 180 operating days per year. That means a house can look attractive at a high nightly rate and still fail the annual math because the legal calendar is not a normal hotel calendar. Barcelona shows another version of the same risk. The city announced plans to let more than 10,000 approved tourist apartment licenses expire by 2028 as part of a housing policy crackdown. The asset did not move. The tourist demand did not disappear. The legal permission did. That is the first hidden lesson: the homestay owner does not fully control the homestay. Then comes the entry price. If you already own a spare room, the first investment may be modest. A better bed, linens, locks, cleaning supplies, professional photos, some safety equipment, and maybe a small license fee. If you are buying an entire property for short-term rental, the math changes completely. Now the business begins with a down payment, closing costs, furnishing, repairs, insurance, taxes, working capital, and a mortgage that has to be paid, whether the calendar is full or empty. In the United States, the median sales price of new houses sold was just over $400,000 in early 2026, according to the Census and HUD series published by the Federal Reserve Bank of St. Louis. Freddie Mac's mortgage survey showed the average 30-year fixed rate around the mid-6% range in late July 2026. Those are not abstract numbers. They decide how much income the house must produce before the owner earns anything. Imagine a property purchased for $450,000. The owner puts roughly $110,000 down, pays closing costs, and finances the rest. The mortgage might require about $26,000 to $28,000 a year before property tax, insurance, utilities, repairs, and furniture replacement. Furnishing a whole house can easily add another $10,000 to $25,000 depending on size and quality. A hot tub, game room, fire pit, sauna, or Instagram-friendly design can push the setup cost much higher. That money is spent before the first review exists. Reviews matter because trust is the raw material. A hotel has a brand, a front desk, a visible building, and a history. A homestay has photos, a description, a host profile, a cancellation policy, a map pin, and social proof from previous guests. Until the first dozen reviews arrive, the property is asking strangers to believe a promise. To fill the gap, the owner often discounts the first stays, over-delivers on amenities, accepts riskier bookings, or spends more time communicating. The platform makes this possible, but the platform also takes power. Airbnb said in its 2025 annual report that it operated a marketplace across more than 220 countries and regions, with more than 5 million hosts and more than 2.5 billion guest arrivals since founding. In 2025, the company reported 533 million nights and seats booked, and more than $91 billion of gross booking value. Booking Holdings reported that Booking.com had about 3.9 million alternative accommodation properties at the end of 2025, and that alternative accommodations represented roughly 36% of Booking.com's room nights. In other words, homes, apartments, villas, cabins, and homestays are no longer a tiny side category. They're part of the global lodging system. That scale is what gives a small owner demand. A family in Germany, a digital nomad from Singapore, a wedding guest from another state, or a backpacker moving through Southeast Asia can discover a house they never would have found alone. The platform handles search, payment, messaging, dispute workflows, calendar tools, and some trust infrastructure. Without it, many homestays would be invisible. Visibility is not the same as control. Airbnb's service fee structure shows the bargaining power clearly. Under the split fee model, most hosts pay a host service fee around 3%, while guests pay a separate service fee that can range from 14.1% to 16.5% of the booking subtotal. Under the single fee model, the entire fee is deducted from the host payout, with many hosts paying around 15.5% and some hospitality or software-connected hosts required to use that structure. The guest may focus on the all-in price. The host may focus on the payout. The platform controls how those two numbers meet. That creates a delicate pricing problem. Raise the nightly rate too much, and the listing falls behind hotels, other homestays, and discounted competitors. Keep the price low, and the owner may win bookings while losing money after cleaning, utilities, mortgage interest, repairs, and taxes. A guest does not care that your mortgage rate is higher than it was 3 years ago. The search page only shows alternatives. The revenue stack looks simple, but it has several layers. The first layer is the nightly rate. That is the visible price guests compare when they search. It changes by season, day of week, local events, school holidays, weather, and competitor supply. A mountain cabin may make most of its money during ski season and lose momentum when snow is weak. A beach homestay may look unbeatable in July and sit half empty in February. A city apartment may depend on conferences, concerts, sporting events, and airline capacity. The second layer is cleaning and turnover economics. Guests often see the cleaning fee as an annoying extra charge. Owners see it as a cost recovery mechanism. The cleaner must be paid, sheets must be washed, towels replaced, supplies refilled, trash removed, damage checked, and the home reset before the next arrival. If cleaning costs $100 and the owner charges $100, the fee is not profit. It is a pass-through that still affects conversion because guests compare total price. The third layer is length of stay strategy. A one-night stay may produce a high nightly rate but heavy turnover. A 7-night stay reduces cleaning frequency and communication load. A 30-night stay may produce lower nightly pricing but steadier occupancy and lower operational friction. Research using Airbnb reservation data in the United States found that average stay lengths remained higher after the pandemic period than before it, partly because remote work created a thicker tail of longer stays. For a homestay owner, that matters, because the same house can be priced as a weekend product, a vacation product, or a temporary living product. The fourth layer is add-ons. Pet fees, extra guest fees, early check-in, late checkout, parking, bike rental, airport pickup, breakfast baskets, guided tours, laundry, local experiences, or direct repeat bookings can add margin. These streams rarely save a bad property, but they can change the outcome for a strong one. A house that earns nothing beyond rent is exposed to every competitor with a cheaper calendar. A house that becomes part of a trip can defend price. After revenue comes the cost machine. Some costs move with bookings: cleaning laundry, guest supplies, payment processing. Minor repairs and customer support rise as occupancy rises. More guests mean more towels, more toilet paper, more messages, more broken glasses, more clogged drains, and more wear on furniture. Other costs do not care whether anyone arrives. The mortgage is due, property tax is due, insurance is due, internet, basic, utilities, landscaping, pest control, security systems, licenses, accounting software, subscriptions, and reserve spending continue. If the owner hired a manager, the manager may take a share of revenue, but the underlying fixed costs remain with the owner. If the home is financed with debt, the lender does not accept a sad calendar as payment. This is operating leverage in plain language. When bookings are strong, the fixed costs are spread across many paid nights and profit can appear quickly. When demand falls, the same fixed costs are spread across fewer nights and the profit disappears even faster. The house is still there, the loan is still there, the cleaning crew is still waiting, the platform still wants guests to find the best value, only the occupied nights changed. Now the central trap comes into view. A homestay gives the owner hotel-like revenue only by accepting hotel-like volatility, platform dependence, hospitality, labor, guest review risk, and local political risk, while still carrying the capital structure of real estate. That combination is dangerous because each part can break a different way. Demand can fall because tourists choose another destination. Supply can rise because too many investors bought similar cabins, condos, villas, or apartments. A new hotel can open nearby with lower rates. A platform algorithm can bury the listing. A single bad review can cut conversion. A neighbor complaint can trigger enforcement. A city can limit permits. An HOA can change its rules. Insurance can rise. Mortgage refinancing can become more expensive. A cleaner can quit before a holiday weekend. A guest can damage the home. A storm can close the road. The owner can win the real estate bet and still lose the operating business. The failure case becomes clearer when the model is scaled up. Sonder was not a small homestay owner. It was a venture-backed lodging company built around apartment-style stays and boutique properties. The company leased or controlled units, furnished them, operated them with technology, and sold them to travelers who wanted something between a hotel and a short-term rental. In theory, the model promised better consistency than a scattered host marketplace, and better flexibility than traditional hotels. The assumption looked reasonable. Urban travelers liked apartment-style stays. Platforms had trained guests to book homes online. Landlords wanted tenants who could take blocks of units. If Sonder could standardize operations and fill rooms at attractive rates, it could become a new kind of hospitality company. The balance sheet told a harder story. In its 2024 annual report, Sonder's auditor warned there was substantial doubt about the company's ability to continue as a going concern because of recurring operating losses and negative operating cash flows. The filing showed more than $800 million of total costs and operating expenses in 2024, a loss from operations of about $183 million, and a net loss of roughly $224 million. It also showed operating lease right-of-use assets of about $1 billion and operating lease liabilities above $1 billion. That is the professional version of the homestay trap. Revenue was variable, guest demand moved, integration, distribution, and operations were hard, lease obligations remained large. In August 2024, Sonder announced a licensing arrangement with Marriott that was supposed to bring thousands of units into Marriott's system and strengthen distribution. By November 2025, Marriott terminated the agreement. Sonder then announced an immediate wind-down and expected Chapter 7 liquidation of its U.S. business. The lesson is not that every homestay becomes Sonder. A single owner with one house does not have billion-dollar lease liabilities. The lesson is that even sophisticated operators can underestimate the gap between selling nights and surviving obligations. A room night business can grow quickly, look modern, attract investors, and still be crushed by fixed commitments when revenue quality is not strong enough. The success case uses the opposite logic. The operators that tend to survive do not treat the property as passive. They treat it as inventory that must be positioned, priced, distributed, maintained, and protected. Airbnb succeeded as a marketplace because it did not have to own every home. It built trust, search, payments, reviews, and global discovery around other people's properties. Booking Holdings succeeded in alternative accommodations because it already had massive travel demand, performance, marketing systems, customer habits, and payment infrastructure. Evolve, a vacation rental management company founded in 2011, says it has delivered more than $5 billion in rental income for owners using pricing, marketing, guest support, and distribution across multiple booking channels. Those businesses are not identical, but the common thread matters. The winners understand that a homestay is not just a real estate asset. It is a distribution business, a reputation business, a pricing business, and an operations business. The owner who depends on one platform, one season, one cleaner, one type of guest, and one optimistic spreadsheet has very little shock absorption. The stronger operator builds backups before the crisis begins. Consider a simple one-year owner model. The property costs $450,000. The owner uses a mortgage and invests additional cash to furnish and prepare the home. In a normal year, the house achieves a 60% occupancy rate across 219 nights at an average daily rate of $220. That creates about $48,000 of lodging revenue. Cleaning fees paid by guests add roughly $11,000, mostly offset by cleaning payments. Pet fees, early check-in, late checkout, and a few direct repeat bookings add another $4,000. Total cash collected looks close to $63,000. Now the money leaves. The mortgage requires about $27,000. Property tax and insurance take $7,500. Utilities, internet, waste, and basic services take $5,500. Maintenance and capital reserves take $6,500 because furniture, mattresses, appliances, paint, locks, towels, and hot tubs do not last forever in a guest house. Supplies, laundry, gaps, software, photos, permits, accounting, and small marketing expenses take another $4,000. Platform fees and payment costs remove around $2,000 under a split fee structure. Or much more if the owner is under a single fee structure and cannot fully raise prices. Cleaning contractor payments may consume almost the entire cleaning fee line. After all that, the owner may have roughly $8,000 to $12,000 before income taxes and before any major surprise. That is not a terrible outcome if the owner also wanted personal use, long-term appreciation, or a second home. It is less impressive if more than $100,000 of cash was invested up front and the owner expected passive income. The return depends heavily on appreciation, financing terms, local regulation, and whether the owner's own labor is being counted as free. Now, change one variable. Occupancy falls from 60% to 42% because supply increases the season is weak or the platform starts showing cheaper competitors. To win bookings, the owner cuts the average daily rate from $220 to $190. Instead of 219 paid nights, the property sells about 153 nights. Lodging revenue falls to roughly $29,000. Add fewer cleaning fees and smaller upsells, and total cash collected might fall toward $40,000. Most fixed costs barely move. The mortgage is still around $27,000, taxes and insurance still arrive, utilities fall only a little because the home must remain conditioned, connected, protected, and ready. Repairs may not fall at all if one bad guest causes damage. By the time the owner pays the unavoidable bills, the property can swing from a small profit to a cash loss of $10,000 or more. That is the part many first-time owners underestimate. The downside does not require a disaster. It only requires a normal-looking combination of softer occupancy, lower rates, higher insurance, and one repair. Customer bargaining power adds another twist. The guest has more information than ever. They can compare the homestay against hotels, service departments, hostels, resorts, and hundreds of nearby listings. They can filter for pools, kitchens, parking, pet-friendly homes, cancellation policies, superhost status, review scores, and total price. A beautiful house with a weak cleaning score can lose to a plainer house with better reviews. A property with a high cleaning fee can look expensive, even if the nightly rate is low. A strict cancellation policy can reduce bookings when competitors offer flexibility. The platform magnifies this pressure because every listing is constantly ranked against substitutes. The owner is not only competing with the house next door, the owner is competing with the platform's idea of what guests are most likely to book. Regulators also gain power when housing pressure rises. A city can argue that short-term rentals reduce long-term housing supply, disturb residential buildings, or shift hotel activity into neighborhoods not designed for it. Whether the owner agrees or not, political risk becomes part of the investment. The more successful homestays become in a constrained housing market, the more visible they become to voters, neighbors, and city officials. This does not mean the business is doomed. A homestay can work when the location is genuinely scarce, the legal permission is secure, the purchase price is disciplined, the debt load is conservative, the guest experience is excellent, and the owner understands seasonality. Before buying a property near a durable demand driver can behave differently from a random house chasing a trend. Ski access, beaches, hospitals, universities, event venues, national parks, pilgrimage sites, historic districts, wedding markets, and remote work destinations can support demand, but only when supply and regulation do not overwhelm the advantage. The best owners also know what they are not. They are not only landlords. A landlord chooses a tenant, signs a lease, and reduces turnover. A homestay owner sells the same space again and again to strangers. They are not only hotel operators. Hotels can spread staff, software maintenance, and marketing across dozens or hundreds of rooms. A homestay owner may have one property carrying all the overhead. They are not only real estate investors. Real estate can appreciate while the operating business loses money. They are not only hosts. Hosts are also risk managers, pricing analysts, maintenance coordinators, tax collectors, customer service agents, and local political actors. The future will make the split sharper. Travel demand remains large. The World Travel and Tourism Council estimated that travel and tourism contributed a record $11.6 trillion to global GDP in 2025 and supported 366 million jobs. More travelers want flexible, local, family-friendly, pet-friendly, and work-friendly accommodation. That helps homestays. At the same time the easy era is fading, cities are writing stricter rules, platforms are changing fee structures and ranking systems, guests are more price-sensitive because total price is easier to compare, hotels are copying apartment-like amenities, professional managers are using dynamic pricing, better photos, direct booking sites, review automation, and channel management. Artificial intelligence will likely make search and pricing more personalized, which may reward truly differentiated homes and punish generic listings that depend only on location. The middle of the market is the most exposed. A unique property with legal protection and strong reviews can still command attention. A cheap room in a high-demand area can still serve budget travelers. A generic second home bought at a high price with expensive debt sits in the danger zone. It must behave like a business, but many owners bought it like a dream. None of this means a homestay is automatically a good or bad investment. The numbers change with location, financing, regulation, taxes, platform rules, guest preferences, and the owner's own operating skill. This is an explanation of the machine, not personalized financial, legal, accounting, tax, or investment advice. The real question is not whether a homestay can make money. Many do. The better question is what kind of money it makes and what must be risked to earn it. At the beginning, the business looked simple. Buy a cute house, take beautiful photos, let travelers arrive, and collect nightly income. Once you own it, the house turns into something more complicated. Empty nights become expired inventory. Reviews become currency. The cleaner becomes critical infrastructure. The platform becomes a powerful distributor. The city becomes a silent partner that can rewrite the rules. The mortgage becomes the bill that never takes a vacation. You thought you were buying a homestay. What you were really buying was a tiny hotel attached to a house, financed like real estate, judged by strangers, ranked by platforms, and governed by rules that can change while the next guest is already on the way.